The U.S. economy is cracking faster, deeper, and far earlier than most analysts want to admit. Over the past few months, three major fault lines have appeared. Consumer spending is weakening, corporate debt is tightening like a vice, and key industries are quietly sliding toward contraction. Today, we're breaking down what's happening beneath the surface and why the next phase could be far more dangerous than anyone expected. The first signs of a serious breakdown are already here, and they're spreading across the economy faster than most people realize. Corporate bankruptcies are rising at the quickest pace in more than a decade, hitting not only small businesses but also mid-sized firms that once looked stable. Many of these companies are being squeezed from both sides, higher operating costs and a sharp slowdown in consumer demand. Tech layoffs are accelerating again, reversing the optimism from late last year. Companies that once hired aggressively are now slashing headcount to preserve cash and protect shrinking profit margins. This wave is no longer limited to startups. Established firms are quietly trimming teams as well. Meanwhile, the American consumer is weakening in a way that's impossible to ignore. Pandemic savings have been depleted, credit card balances are at record highs, and delinquency rates are jumping, especially among younger and lower-income households. Even everyday essentials are becoming harder for many families to afford. These cracks aren't isolated events. They're early indicators of a system under growing stress, and together, they paint a picture of an economy losing stability much faster than expected. The hard data now confirms what the headlines have been hinting at. The U.S. economy is losing momentum, and it's happening across multiple core indicators at the same time. GDP growth has been revised downward for consecutive quarters, signaling that the economy is slowing far earlier than policymakers expected. Consumer spending, traditionally the strongest pillar, has weakened to levels usually seen right before recessions. Households are no longer able to maintain the pace of post-pandemic consumption, and the slowdown is becoming visible in retail sales, services demand, and discretionary purchases. Credit stress is building rapidly. Credit card delinquency rates are at their highest since the Great Financial Crisis, while auto loan defaults are rising at an alarming speed. Subprime borrowers are struggling the most, but prime borrowers, people with good credit, are also falling behind, which is a major red flag. Total household debt has reached another all-time high, and the cost of servicing that debt continues to climb. Manufacturing remains in contraction territory, with the PMI index stuck below 50 for months. New orders are slowing, inventories are rising, and factory hiring has cooled significantly. Even the labor market, once considered the stabilizing force of the economy, is starting to soften. Job openings are falling, hiring freezes are spreading, and wage growth has stalled. None of these indicators alone would guarantee a downturn. But when every major metric turns red simultaneously, it signals the beginning of a deeper structural weakening, one that's already underway. The question now is, why are these cracks spreading so quickly? A slowdown doesn't usually escalate this fast unless multiple forces are converging at the same time. And right now, three structural pressures are accelerating the deterioration of the U.S. economy. The first force is prolonged high interest rates, which are exerting intense pressure on every layer of the system. For consumers, higher borrowing costs mean credit card balances grow faster than incomes, auto loans become unaffordable, and mortgages push homeownership out of reach. For businesses, it means debt refinancing becomes more expensive, profit margins shrink, and expansion plans are put on hold. This is especially damaging for small and mid-sized companies that rely heavily on loans to manage cash flow. As credit tightens, they face a brutal choice: cut jobs, cut investment, or close entirely. We're now seeing all three happening at once. The second force is deteriorating corporate profitability beneath the surface. While headline earnings have looked strong on the surface, driven mostly by a handful of mega-cap tech firms, the majority of companies are struggling. Revenue growth is slowing, inventories are piling up, and the cost of capital has risen sharply. To protect shrinking margins, companies first cut discretionary spending, then freeze hiring, and finally move to layoffs. What's alarming is that even highly profitable firms are now cutting staff, which signals deeper weakness in demand rather than temporary cost management. The third force is the growing fragility of the American consumer. For nearly 2 years, consumers were able to maintain spending despite inflation, largely by relying on savings and credit. But those buffers are now exhausted. Delinquencies are climbing not only in subprime categories but also among households with strong credit histories. That shift indicates systemic stress, not isolated hardship. When consumers pull back simultaneously, businesses immediately feel the pressure. Sales decline, cash flow tightens, and the cycle feeds back into more layoffs and more cautious lending from banks. Together, these forces create a powerful self-reinforcing loop. High rates weaken consumers. Weakened consumers reduce spending hurts corporate earnings. Weakened earnings trigger layoffs. Layoffs further weaken consumers. This loop is why the cracks are not only appearing but accelerating. And once a feedback cycle like this gains momentum, it becomes extremely difficult to stop without meaningful intervention. So what happens if these pressures continue to build? Economic slowdowns don't become recessions overnight. They turn into recessions through chain reactions, when weakness in one area spills into another. And right now, that sequence is already forming. The first stage is corporate earnings deterioration. As consumers pull back, companies miss revenue targets and feel the hit in their quarterly reports. Investors begin to lose confidence, stock prices turn volatile, and executive teams respond by cutting costs aggressively. This is where hiring freezes transform into layoffs, and layoffs are the key turning point. The second stage is labor market stress. When job cuts spread from tech into retail, logistics, and manufacturing, income stability disappears. Millions of households become more cautious, and even minor financial shocks like a car repair or medical bill can push them into deeper debt. Once job insecurity rises, consumer spending falls sharply, amplifying the downturn. The third stage is credit tightening. Banks, seeing rising delinquencies, become more selective with lending. Small businesses, which depend heavily on credit lines for day-to-day operations, face sudden funding shortages. Projects are paused, expansion plans are canceled. Some companies close simply because they can no longer access working capital. The fourth stage is housing market deterioration. High mortgage rates already froze buyers out of the market, but a weakened labor market pushes housing into a deeper slump. Price corrections begin in weaker regions and gradually spread nationwide, dragging down household wealth and consumer confidence. And once confidence breaks that final psychological shift, the downturn accelerates on its own. Consumers stop spending, businesses panic, banks retreat, and the economic cracks turn into a structural fracture. This is how a slowdown becomes a crisis, not through a single event, but through an interconnected chain reaction that's already unfolding. The U.S. economy isn't collapsing overnight, but the direction is unmistakable. The cracks we're seeing today are no longer isolated warning signs. They're part of a much broader structural shift. Debt is rising, consumers are weakening, corporate earnings are softening, and the job market, once the strongest pillar, is beginning to lose momentum. When all of these pressures converge, the system becomes far more fragile than it appears on the surface. The next few months will determine whether these cracks remain contained or spread into something much larger. And if one sector is positioned to trigger that shift, it's the tech industry. Tech has carried the U.S. economy for more than a decade, driving innovation, profits, and market stability. But now, even this powerhouse is showing signs of strain, slowing revenues, aggressive cost-cutting, and the first hints of demand fatigue. If the tech sector breaks, it won't just be another downturn. It could be the spark that exposes the deeper vulnerabilities across the entire economy. In our next episode, we'll break this down in detail. What happens when the tech sector cracks and why it could trigger a far deeper crisis? If you want to understand where the next major shift is coming from, you won't want to miss it.